We can't help but notice that the market doesn't seem to be calm. Futures are down in the morning, they come up a little bit, they come back down a little bit, then they come up a little bit, and we close where we close. In addition, there's a lot of headlines about, whoa, somebody was able to take 5-to-1 margin, dumped a ton of stock on Friday. There's some weird things going on, and it's very fair for people to be asking questions, to raise some concerns, and to be pointed in the direction of wanting to liquidate some of their portfolio themselves. Some people might be a little concerned right here in this environment, and I understand that. But I want to address it, and I don't think that is the long-term case in this environment. So one of the things that I think was giving pressure to stocks, in addition to all the negative headlines, was the 10-year Treasury yield. Back up, breaking 1.7%. It's a pretty high percent relative to what we've seen in the last year. And that's on this idea that we're going to get another $3 trillion in stimulus. And not all of it's going to be going to infrastructure. We could see if we were going to have a $3 trillion infrastructure plan, that would be spread out over a number of years, likely 10 years, would go directly to jobs and these kinds of things. Now we're finding out a portion of that is going to be to healthcare. So there's likely to be more increase to the money supply, which is likely to cause some inflation. This will be the Federal Reserve printing money to buy U.S. debt and then essentially making the debt go away. We'll see what happens. But when bonds hear that, they say, whoa, this is inflation occurring. This is inflation occurring. We don't like that. We are, buying the opportunity to receive cash in the future. We need to receive some more cash than we are currently getting in order to compensate for the new expectations of inflation. That's what's happening in the bond market. And that notion of, wow, future cash flows, they gotta compete because we're getting this better cash flow now in terms of nominal dollars from bonds. And that makes stocks that are promising future cash flows less competitive to those bonds. But what I think the market is getting wrong there is that notion of them becoming less competitive. I think they will be more competitive and adjusted at the same or a similar rate. Stocks, if there is inflation, will benefit. Cash flows of the stocks will increase as well because price levels will increase. And one could be concerned that, wait, if prices increase, input prices might increase as well, and that will hurt margins. Well, that hasn't happened in the housing market. We've seen the housing market remain strong. We have even seen demand for homes remain strong. As input prices have risen, sales prices have risen, and yes, demand has risen because the economy is holding up, at least for people in the home buying market. They have good balance sheets, savings rates are at all-time highs, so there are some good signs in that regard, and hopefully that will transition to the broader economy. Now, some people might say, inflation, my groceries are relatively the same price. I'm not seeing anything crazy. Well, there's certainly some inflation. And basically every single commodity price, there's some inflation. It's inflation across the board. If you look into it deeply, there is inflation. It is occurring. Cannot be serious enough about that. CEOs are talking about inflation occurring. And I think this is the beginning because we're going to see another $3 trillion stimulus package. That isn't in a time where there could be some deflation and depressed demand. We're going to see inflation and appreciating demand for goods and services, which will cause inflation, which is ultimately good for stocks. So that is the fundamental case. That is what I see as the long-term thesis, inflation alone, carrying stocks, combined with a possibly good reopening economy. Although I'm becoming increasingly worried about that, at least for the people at the bottom, if they're just going to keep getting this free money, which might lead to some inflation. So they're going to probably be okay, but they need to get to work. I'm seeing too many homeless people while I'm, doing Uber Eats. And I did Uber Eats before I got paid from this stuff, when I had basically, not a lot of money just lying around. Got a car loan with not that much credit. Started making 25, 30, 40 an hour sometimes with Uber Eats. I work. I'm afraid some people won't work, and that might affect the long-term productivity curve, which is an important thing to consider. So there's a lot of things going on right now. What I think is going to happen is stocks are going to continue to increase in nominal terms. Whether or not they increase in real terms, so whether or not they are equally as productive, are they making as much stuff, are people buying as much stuff, that's, I'm becoming slightly more concerned about that. But given that the United States and the rest of the world is printing money to provide stimulus to their people, I think there's a good chance that stocks just continue to rise in nominal terms for now. And if we switch to Bitcoin, maybe that won't be the case. Maybe they'll go a little more flat. But for now, they will likely go up. So I hope that addressed everything. I hope that was concise and thought step by step as best as it could with no script, off the cuff. So until next time, peace out.